Another fellow wants investment information. We really aren't in the investment information business. We disclose what we have to disclose, but we could set up an investment advisory firm and probably take in a lot of money, but we haven't done it, and we aren't giving away what belongs to our shareholders for nothing. But he's correct that I'm 99% sure he's correct, and Mark Hamburg can correct me, but from our office. But we do not have to report foreign stocks, and we do have in certain important countries, there's lower thresholds at which we have to report our holdings as a percentage of the company's stock outstanding. There's lower thresholds than there are in the United States. So in a sense, in certain stocks, I think when we bought Munich Re stock or bought Tesco stock, or there's certain stocks we've had to report at before we would have had to report in the United States. But we will never unnecessarily advise if we plan to buy some land someplace, if we plan to develop a business. We are not about giving business information that's proprietary to Berkshire. We don't give it unless we're required by law. And he is correct that I'm virtually certain that we do not have to report our foreign stocks to on the SEC filings. And he'll have to find his own holdings in Austria. I think his Mozart story may have encouraged that particular question from Austria, what stocks we're going to own in Austria. Okay, Charlie, do you have any comments?
No.
No, I didn't think you would. I sold securities for a while, but in May of 1956, I had a number of members of my family. I'd come back from New York, and they wanted me to help them out with stocks as I had earlier before I'd taken a job in New York. And I said I did not want to get in the stock sales business, but I wanted to. I enjoyed investing. I was glad to figure out a way to do it, which I did through a partnership form. But I would not have done that if I thought there was any chance, really, that I would lose them money. And what I was worried about was not how I would behave, but how they would behave. Because I needed people who were in sync with me. So when we sat down for dinner in May of 1956 with 7 people who either were related to me or one was a roommate in college and his mother, and I showed them the partnership agreement. And I said, you don't need to read this. There's no way that I'm doing anything in the agreement that there's any way that you don't need a lawyer to read or anything of the sort. But I said, here are the ground rules as to what I think I can do and how I want to be judged. And if you're in sync with me, I want to manage your money, because then I won't worry about the fact that you will panic if the market goes down or somebody tells you something different. So we have to be on the same page. And if we're on the same page, then I'm not worried about managing your money. And if we aren't on the same page, I don't want to manage your money, because you may be disappointed when I think that things are even better to be investing and so on. So I don't think you want to manage other people's money until you have a vehicle and can reach the kind of people that will be in sync with you. I think you ought to have your own ground rules as to what your expectations are, when they should send you roses and when they should throw bricks at you, and you want to be on the same. And that's one reason we didn't have a single institution in the partnership, because institutions meant committees, and committees meant that
you had some aunts that trusted you.
What's that?
You had some aunts who trusted you.
Yeah, well, and a father-in-law that gave me everything he had in the world, but I didn't mind taking everything he had in the world, as long as he would stick with me and wouldn't get panicked by headlines and that sort of thing. And so it's enormously important that you don't take people that have expectations of you that you can't meet. And that means you turn down a lot of people, it means you probably start very small and you get an audited record. And when you've got the confidence where if your own parents came to you and they were going to give you all their money and you were going to invest for them, you've got the kind of confidence that you'll say, I may not get the best record, but I'll be sure that you get a decent record over time. That's when you're ready to go on it.
Let me tell you a story that I tell young lawyers who frequently come to me and say, how can I quit practicing law and become a billionaire instead? And so I say, well, it reminds me of a story they told about Mozart. A young man came to him and he said, I want to compose symphonies and I want to talk to you about that. And Mozart said, how old are you? And the man said, 22. And Mozart said, you're too young to do symphonies. And the guy says, but you were writing symphonies when you were 10 years old. He says, yes, but I wasn't running around asking other people how to do it.
Carol, we wish you well. And, but, and actually we really do, because the fact you asked that sort of a question is to some extent indicative of the fact that you got the right attitude going in.
It isn't that easy to be a great investor. I don't think we've quite made it.
I was kind of surprised, though, to see you move to trim all of your holdings where possible on a regular basis to eliminate the regulatory requirements that come with ownership levels above 10%, which in my view limits the investable universe that Berkshire, or at least Warren, can meaningfully invest in longer term, given that Warren manages a large chunk of Berkshire's $200 billion equity portfolio. Could you elaborate more on the regulatory impact for Berkshire of holding more than 10% of any company's stock, as well as how you feel about the Fed's recent proposal to allow investors like Berkshire to own up to 25% of the shares of a bank without triggering more restrictive rules and oversight? Yeah. Basically, if that proposal were to come to fruition, would you be willing to forego that 10% threshold self-imposed that you've done and put money to work in names that you're already fairly comfortable with?
Yeah, the 10%, there's a couple of reasons.
That's the right answer, yeah.
Yeah. We will, there's two factors beyond, in the case of banks, there's the Federal Reserve requirement there. But many people probably don't even, might not know about this, but if you own over 10% of a security, common stock, and you sell it within 6 months at a profit, you give the money over to the company. It's a sword swing profit that you give them, and you match any sale against your lowest purchase. And I think if you sell it and then buy it within 6 months, I'm not as positive about that because I haven't really read the rule for a lot of years. But I think if you sell and then buy within 6 months and the purchase is below the price at which you made the sale, you owe the money to the company. There used to be lawyers that would scan that monthly SEC report that I used to get 30 or 40 years ago. They would scan it to find people that inadvertently had broken that rule, and they would get paid a fee for recovering it for the company. So it restricts significantly your ability to reverse a position or change your mind or something of the sort. Secondly, I think you have to report within 2 or 3 business days every purchase you make once you're in that over 10% factor. So you're advertising to the world, and the world tends to follow us some. So it has a huge execution cost attached to it. Nevertheless, and those are both significant minuses, and they're both things that people generally don't think about. We did go over recently, for example, in Delta Airlines. That was actually an accident, but I don't mind the fact at all that we did. And if the Federal Reserve changes its approach, we won't have to trim down below that. We don't want to become a bank holding company, and we don't want to We went in many years ago and got permission with Wells, but then our permission expired, and we went in again a couple of years ago, and we spent a year or so, and there were just a million questions that Wells got asked about us and so on. So it's been a deterrent. It'll be less of a deterrent in the future, but it does have those two. The short swing thing is less onerous to us than it would be to most people who buy and sell stocks, because we don't really think in terms of doing much with
But
them.
if we didn't have all these damn rules, we would cheerfully buy more, wouldn't we?
Sure. Yeah. Well, anytime we buy it, we do it cheerfully, but we will. You'll probably see us at more than 10% in more things. And if the Fed should change its rules, there will be companies where we drift up over 10% simply because they're repurchasing their shares. That's been the case with Wells, and it's been the case with an airline or two in the last year or so. If we like 9.5% of a company, we'd like 15% better. And you may see us behave a little differently on that in the future.
Well, one more awkward disadvantage of being extremely rich.
Yeah. And it really is. I mean, yeah, and people following you. I mean, the followers' problem can be a real problem. Okay, station 6.